Okay, everyone, welcome to another episode of Line Your Own Pockets. Today, we're actually answering a question from our YouTube comments. So remember, you can comment and we read and sometimes respond via text, and sometimes we respond via video if it's a good enough question. So I'll let Dave read the question here, but while he's reading, I've got something I have to put on here. So for audio only listeners, I am currently wearing a tinfoil hat for Dave to read this question. So, so go nuts.
I love
I didn't
that.
even
All
tell
right.
him I was going to do that. So,
All right. So the question is from Arthur Deroshev. It's a couple months ago, responding to one of our podcasts. And it said, we consider discussing in one of your future episodes, the topic of how to avoid being stopped out by algorithms and how to figure out the most logical location to put a stop loss.
okay, no, I'm not.
I
I'm not
love
going to
this
wear this all
topic.
the time.
I love this topic because there's a certain phase you go through as a trader where you start hearing people talk about how people are going for your stops, or they're you know these algos are going for certain people's stops, and you may be targeted, so be careful, right? What do you think about that,
Yes.
Michael?
Oh man, so this is going to be a fun one because I think we're going to agree here, but I still think it's going to be funny anyway. I'm going to say there is a certain amount of that going on, but not in the way that you think about it, right? So, first of all, I think any conspiracy theory generally just gets debunked by saying how many people would have to keep the secret in order
Yeah,
for it to work, right? So the way I look at
totally.
it is saying, so if the market makers, the algos, the citadels, the Ken Griffins, the scary names, if they knew where your stop was, it would have to be them, everyone who works for their company now, everyone who's ever worked for their company, and never having exposed the code or the algo or whatever that knows where everyone's stop is. So that's kind of going to be right off the bat, is I think it's a lot of BS, but I think there's like psychological reasons why people think it happens, and I think that's going to be important to look at. Now, just in case you have a different opinion, I don't know, maybe we'll have to cancel this podcast if Dave's like, oh no, they know where my stops are. They've put a camera in my house.
Yeah, so. I think it's all BS. Um, And the way I think it gets propagated out there and the way people become so susceptible to it is for, I think, basically two reasons. One is you have some pretty well known gurus out there, some of which we know personally, Michael,
Mm-hmm.
that kind of put this out there as a reason that certain things happen. And it's like it puts out they're presenting as if, hey, I'm in the know. I have this deep knowledge that nobody else does. I'm sort of in touch with this underground world that maybe you're not a part of. So come join my trading room, or you should follow me, right?
And it's funny, as you describe that, that is always the same with all conspiracy theories, right? There's a certain level, I think, of a humans wanting to be a part of an exclusive club. And if I
Yeah,
know this thing that no one else knows, then that kind of puts me square into this club and makes me feel better about what's going on, even though, right, the guy who invited you to the club is also just kind of making things up.
yeah. I think it's a good. Another place you see a lot of conspiracy theories is political theory. Politics in general,
I have
and
not noticed that at all being on Twitter, being and as the Canadian looking down at you guys, there's been none, I don't know what you're talking about.
yeah, and it's one thing. You could almost believe that like the smartest hedge funds in the world could pull off something like this. But when you step back and think about, like the moon landing, there's some people that think that's a big conspiracy and it never happened, right?
Hmm.
Well, have you met, do you know politicians? I mean, these aren't the smartest cookies in the world, right? So
Yeah.
not only would you have to be really smart to pull it off, but you're right. You have to coordinate a lot of people, and nobody can defect. It just takes one person to defect and spill the beans for it all to fall apart. So,
Well,
Um,
and I think before we go too far, let's go back and let's try to figure out why people believe this. And I, it's I think it's obvious why, and I think it's we've all had it happen, and it's all when you have a stop out at a price and your stock goes right to that price and then reverses, right? And I think the problem is we have something in our brain as humans where we remember all the times we got screwed really bad and not all of the other times. So you remember the time that you had to stop out at 10 bucks and it went to like 9.99 and then it ripped all day and it would have made you thousands of dollars. We don't remember the times that are way more plentiful where it went to 8, right? And your stop was good. Or, it went to 9.50 and hung out there for a while and all of these things. So through just random chance, you put out a stop, the price goes exactly to that stop loss and then moves off it. And we cement that in our mind as that's the bad thing that's occurred. And then we go from there. So I just want to just kind of go and say, hey, there's a reason that's based around actual experience that people believe this. They're just wrong about what has occurred and how often it occurs and why it's kind of happened, right?
I think that's definitely true. And I think it's even deeper for why people are so susceptible to it. And that's that, it's human nature to like want to blame somebody else.
Mm-hmm.
If you've done all this work, you've created this idea, you've executed the trade, and it just went against you, and you were so close. The tendency is, well, I want to blame somebody else, right? And that's the sign of a hobbyist trader.
Yes.
There's a phase you go through where you need to fully embrace and fully take responsibility for your own trading, no matter what. Like even if your broker's platform screwed up and cost you a lot of money, right? Because
Mm-hmm.
their platform failed. Still, like that is nobody else's responsibility but you. You have to be
Yep.
able to control what you can control. And a lot of these factors are out of your control. So I think that's part of what, like, it's just you want to blame somebody else. And that's a phase you go through that the quicker you get through that, the better off you're going to be.
Well, and that's life, right? We all know the people who, regardless, you ask them how they're doing, and then it just in a offhanded, "How you doing, bud?" And then there's a 20-minute rant about how the world's out to get them and everything's
Yeah.
bad and this kind of and that because you're right, that attitude. As soon as I see that in a trader, in my head, I know that there's no chance, right? And maybe they shake it off and they move on, but as soon as you're blaming the algos and the hedge funds and the statistics. And this is someone who worked in the hedge fund space for 10 years and worked in the prop firm space. I've seen the inside of these buildings, and there's nothing conspiratorial going on because they all hate each other, right? Hedge fund A is competing against hedge fund B that's competing against hedge fund C. So it's 100% right of saying, I just want to pass what I'm doing on to some other body out there. And then that makes me feel better about what's going on. But I could not agree more that that is the absolute worst attitude to have as a trader,
Yeah.
because you have to do. And we like book recommendations here. I think a really good one I remember reading a while back was Extreme Ownership by this Jacko Willink guy. He's just basically going through, he was military guy back in the day and was in a couple incidences that really went poorly and cost lives and everything. And he just talked about how he had to own every. It's a great book. So a really good one to read.
Yeah, I've heard that name, and I suspect that is a good book. And yeah, uh, it, take ownership as quickly as you can. I mean, that's the way to do it.
Mm-hmm.
I mean, you just think about the sort of the mindset you would slip into if you allowed yourself to believe that somebody was out to get you or this was happening, right? Just think what happens to your path to confidence there for your strategy. Like you
Mm-hmm.
have no path. If you're blaming somebody else, then you're saying to yourself, okay, well, there's nothing I can do here. I can't scale up in this strategy with a lot of size because there's this unknown force that's out to get me and get my stop that's here on my 100 share position in a
Yeah.
$5 stock, right? Okay,
Yeah.
let's be real.
And
But
that's the
yes,
other thing I think that should help disprove it to you is that a lot of people, right? say you're trading Microsoft. I've actually heard an example of some guy who had 200 share order out in Microsoft. They came and got my stop. It's like, okay, so just think of the mechanics behind that. It would have cost some fund millions of dollars to move
Yeah.
that stock, the 20 cents it would have taken to hit your stop for $100 and then come back. So this company would have lost like hundreds of thousands of dollars just to smite you. And I really like that path of confidence idea because it's pure defeatist. If the market is rigged and there's an algo out there that's looking at what you're doing and taking the other side and all this kind of stuff, just stop. There's no point. Right? There's just no point in doing it because you would always be against this system that if you believe exists and you believe is kind of manipulating the market, then this isn't the game for you. You should go do something else, right? Invest in an index fund and call it a day. Not, disparaging. It's not a bad thing. It's, to be honest, what a lot of people should do. But if there's no way to win, if there's someone out there who's watching you, then you're right. There's no path to confidence. There's no way out, right?
Yeah. Well, I've got several thoughts about this. Even if you knew it was true, even if it was true that there was this conspiracy where people go after stops.
Okay.
Yeah. Well, there you go.
Let's put on the
Michael put his tinfoil hat again. So even if you knew it was true, that doesn't mean you should necessarily quit, because I think you can. There are things you can do to minimize it, even if it's true. Like there's it's not an all powerful force. There's no way it could be an all powerful force because they would need, like you said, they would need to invest a ton of money to get your silly stop. So, but even if you thought it was happening, you could still do stuff to prevent it and to avoid it and to maximize or optimize your strategy in such a way to minimize this. So,
Okay,
and that's
let's
by selecting stops that are optimal.
So let's go. Yeah, let's go down that road a little bit. Now, the one leeway, I don't even know if you'll agree with this or not, that I will give these people is that although they're not haunting your stop and they don't know where you are and they don't know where your 100 shares are, I think some of this may occur if you're doing something that's obvious. So, for example, if I am a market maker, right, and I do want some liquidity, and I know that, above yesterday's high or yesterday's low, there might be some action there. Maybe I'll kind of give you that on the margins, that if you're putting your stop in a very obvious place where the market maker doesn't know, but believes there's hundreds of people who've also put stops there, maybe. So that's kind of like if I could put half a tinfoil hat on, I would do that. So I think, the solution that we can come in, we'll talk about optimal stops, is okay, first of all, let's not put our stop where everyone in the world would. Maybe that's one place to keep an eye on, right? So when we're talking about putting an optimal stop down, and let's, again, put the tinfoil hat on and say they are looking for you. So what's the selection criteria for a stop then?
Okay, well, let's back up a little bit to the example you gave earlier, that if you've traded for any length of time, you've had happen where your stop gets hit to the very exact penny and it goes the other direction.
Yep.
And so I remember seeing an article written by a very well-known trading publication. Everybody on this podcast would probably have heard of this. And it was about a trader who had this experience where their stop got hit. Oh man, they were so frustrated. And here's what they were going to do to do some research and prevent this situation in the future. And my initial reaction was, that is the exact wrong approach. Because if you have an optimal stop set, you are guaranteed to have this happen pretty frequently, right? And it's not a bad thing. It's actually a good thing when this happens, because you've selected a stop that's really close to optimal and probably is optimal. If you have the optimal stop set, this will happen to you frequently. And that's kind of what you want. Of course, it's frustrating, but that's a sign that you've set it pretty dang well, right?
Yes. So just to clarify on that, and couldn't agree more, is that if your stock is turning around at roughly the area that you have a stop loss at, that means that you're picking the direction of your trade correctly and that your stop is makes sense even though it was hit this time, but it's in an area that is you could see worlds where it got really close and then reversed just as easily as touched it to the tick and just reversed. And by knowing that that's happening frequently, you're knowing that, okay, at least I'm in the ballpark. I'm in the area of where I should kind of do or die, get in or out. Because if it surpasses that area, likely it's going to continue. But at least I'm on to something. And if I want to kind of try a little bit as well,
Yeah, and if this
it's general zone. You're on the right path.
Yeah, and if this isn't happening to you on a pretty regular basis, then you should revisit your stop. You probably are leaving a lot of money on the table by not having it optimally set. So if it's too far away, like let's say you have one that's too far away, so this never happens to you, right? Then you're leaving a lot of money on the table because if you had a smaller stop, you could be taking a larger position size
Right.
and you could be and your system would be way better. I mean, this is how you scale trading systems, is figuring out optimal places to put the stop and sizing your position based on it. So if this is not happening to you, then I think there's a problem. Like, this should be a good thing that this happens to you, and you should recognize it as such.
And I think it goes back to that pain thing the pain avoidance that we always talk about, is that people don't like to get stopped out because they kind of in their brain look at it as like a failure or bad thing. But you're right, you should be getting stopped out frequently, right? The best trading strategies have somewhere in the neighborhood of a 50-50 win rate, whether it's 60% or whether it's 40%. And if your stop is too tight, you're going to be wiggled out of trades that would be good anyway, and that's bad. But if your stop is too loose, you have to trade such anemic position size that you're not going to make any real money on the strategy anyway. So you want to find that happy middle ground where you're getting stopped out enough that you are able to size up and still be comfortable where the stop loss and everything is, but you're not getting stopped out on every single trade. So what is that middle ground in that zone? And I think that kind of leads to more selection criteria, right? Most people may put their stop in obvious places, right? So, I know that in the beginning, I did a lot of my stops on, a prior day's high or a low or something like that. And I think the question you got to ask yourself, is that optimal? And the only way you know is by going through and testing the data and seeing, if you loosen it a bit or tighten it a bit or move it around, use it based off ATR or volatility or something like that, how much does it change that strategy's overall results in the long run? And then not be too worried about, right? Yeah, you got stopped out these 3 times to the tick and then it reversed on you.
Yeah. So the way that I approach this is, so I wrote a post on this. I think you could search for Dave May, how I choose stops, and this article should pop up. It's basically the approach I take. So basically what I do is create a back test, like the same logic, except for there's no stops or targets. There's only a time stop. And there's a couple data points to include in your back test that allow you to figure out the optimal stop to use. One of them is called maximum adverse excursion. And that's like a silly, fancy word that all it's pointing at is, what's the point during the lifetime of the trade where it was least profitable?
Right.
So, imagine you buy a stock at 100. During the course of the trade, it goes down to 99. It goes up to 102. And then by the time your time stop is reached, it's at 101, say. Well, the maximum adverse excursion, the point at which the trade was the most against you, was 99. So when you can capture that per trade, you have a great way to optimize across the entire strategy in aggregate. And so you can know exactly, the point at which to use. And there's 3 graphs I look at, and you can go to that post and see it, that show you, that tell me exactly what the win rate would be, exactly what the total profit would be, how often the stop is being hit, and I can see at different levels, um, iterating on this maximum adverse excursion, exactly what it would be to be optimal. And I can choose one. Um, and there's some trade-offs there, but that's the right way to do it. And once you do it that way, you don't have to worry about any of the conspiracy theories, right? You know
Hmm.
that you've chosen one that's going to work across a large number of your trades. Any one trade doesn't matter, right?
Yeah.
And that's the right way to do it.
And do you do that just, might as well just keep going down this hole because I like this, but is that how you build every strategy? Because I was just the way you're describing, that's how I do it, where I want to build at first naked, I guess you could call it, no stop loss, no profit target, none of that, just a, like you mentioned, a time stop. Easiest to describe, I think, for day trades is if I buy the stock here based off these criterias or sell the stock here based off these criterias, what is the probability that it is higher or lower at the end of the day, and by how much? And then after that is done and somewhat optimized and looks good, then I start to do this kind of work of stop optimization where I build the setup, I guess, entirely in its entirety before I'm even thinking about stop loss or profit target, because I just want to know. And there's some things you do when you're back testing, like if the profit is being hurt by just a number of tail events, a number of large losses, then as you're building, you kind of put those aside because a stop loss will just naturally take care of it whenever it's put in. But yeah, it's just the way you described it. I'm like, that's how I build everything. So do you do everything like that, or do you do some
So that,
combination?
yeah, I think for most every strategy I trade, I am always thinking about that approach. Sometimes, I mean, some strategies there's not a specific right answer and right path for every strategy, but I think for the most of the strategies that people would be thinking about that are listening to the podcast, I think that's a great default approach. I think the more interesting question is, do you select the stop before you do optimization, or do you do optimization first and then select your stop? I think that's an open question. I don't think there's a right answer to that, but um,
That was gonna be my question to you, because I've done generally I'll do both. So, and what I mean by that is I will create two, like I'll branch it. Like, so this is the base strategy. This is the strategy with the
mhm.
most amount of trades. It's just the summation of the idea that I have essentially. And then I do it both ways and then take a good long think about it. Right. So
Yeah,
I will do an optimization naked and then do that by maximum adverse and maximum favorable excursion, which I should just clarify that it is generally done with like an ATR or using a prior day's range or something like that. It's not a percentage or dollar amount. I think we could, I don't know if we did a podcast, but if we didn't, we should, about how everything should be normalized. I think there's still a lot of people who don't normalize that kind of data. So I'll do that first. I'll do the optimization first and then add the stop loss. And then I will do the other side where I add the stop loss and maybe the profit target first. And then I'll do the optimization and then look at what the differences in the
yeah,
optimization was. If it's all the same all the way down, doesn't matter anyway. If I end up at the exact same point going in both directions, then I know it doesn't matter. If I end up in two completely different points, then it just creates a question for why. And then I
yeah,
try to figure out a way to get, to that similar points again, and just keep going kind of until I get there.
yeah. I like that approach. Like I said, I don't think either one of those approaches are right in every situation, but I think that's in general a good way to do it, because you're going to be pointed to some things that are really interesting, like the difference that So I run the cruncher on a lot of my strategies, and I'll do it with and without a stop, and you get some very different answers based on it, right?
Hmm.
And that's really super interesting, because that's going to point you to the why. Why is that happening? And when you figure that out and dig in and see why that is, that can lead to some other trains of thought, perhaps some other strategy ideas for the ramifications that come from that.
Yeah,
Um,
you always get the most interesting responses when you end up in two different locations based off the methodology, the sequence of optimization versus putting your stop. When they end up at the same place, that gives a lot of confidence of just saying, okay,
Yeah.
right, the strategy kind of works just regardless of how I approach or how I skin this cat. But when you get to two different locations, that's kind of the eyebrow raising, why and what can I learn from that?
Yeah, and think about exactly what's happening when you include a stop versus not including a stop. What you're doing is, think about the ones that the big losing trades that would have got stopped out for amount X, but they went a long way against you, right?
Hmm.
When you put a stop in there before you optimize, you're basically counting those trades the same as ones that just barely stopped out and then went in your favor, right?
Yeah.
Well, that doesn't make a lot of sense, right? To treat those the same,
Hmm.
like why would you do that? Like this one went against you and it went way, way against you, right? So, but including a stop, you treat those exactly the same way statistically.
Yeah.
So there's that, and that's a trade-off you make for simplicity and um, for using stops in general. So that's one big advantage of not using stops in your back test. So you can see like you're valuing those in a way that makes more sense to the original idea. But what you end up with there is big outliers. Like you said, you end up with really large outliers that can skew the results pretty dramatically. So, I mean, one thing you can do there is have some floor well beyond your stop, but at a level that um, you know basically cuts off the outliers
Hmm.
and see what that does. A lot of times you'll see. I've had I've had some outliers and some strategies that I've tested where literally one trade, it was such an outlier, it made the edge, it flipped the edge. Like the edge was on the opposite side when you included this, which was kind of crazy, right? That's a huge outlier.
Yeah.
But yeah, you can see some dramatically different results when you play around with this.
And just for the swing trading crowd, one method to do that I always like, as opposed to using stop losses, you do based off the close of a bar, right? So when a bar closes in a certain condition, right, under a moving average or volatility trailing stop or whatever, then you exit on the next bar. And the idea there is that you get a lot of that wiggle out of the way. Like you mentioned, the ones that would have come and hit the stop that day and then rallied to the end of the day and then closed strong. By doing that, and I guess you could do that from the intraday point of view as well, depending on the bars you're looking at. You're saying, instead of just exiting at a certain price, exiting based off a certain criteria, when a bar closes. So you're not just saying, I'm going to stop out at this price. I'm going to stop out when this condition occurs. And in that case, I find sometimes that just leads a whole nother kind of rabbit hole and a whole nother couple questions to answer, because sometimes that's a little better, right? A moving average crossover is your exit, or something like that. What you get there is you don't get like the really hard defensive line of, I'm putting my foot down. If it violates this price, I'm out. So you get some larger than expected losses, but you trade off, and like we talk about with everything in trading, a lot of it's like a trade off. Like, generally speaking, stop loss is what you're doing is you're lowering your win rate, and in hopes of increasing your profit over time, and more importantly, smoothing that profit over time. That's essentially what you're doing with a stop loss.
Yeah, well, I think about it a little bit differently. I think about it as uh, stop losses are always suboptimal, or they should be. They should
Yep.
be like if you back tested your strategy without a stop, it should be better than when you test it with a stop. But
Hmm.
stops are like the way mere mortals can actually execute a strategy, right?
Yeah.
Um, and it's how you make it tradable in the real world with your human nature and psychology.
Well, and it's
Because
funny.
if you don't use stops, then yeah, you're gonna have some swings that are rough to deal with.
And that's in the Market Wizards books with Marston, who we've had on the podcast and builds real tests that I use for back testing. he talked a lot about that. He had a mean reversion system, and he was more of a swing trader. And he said, it worked way better without a stop loss. So he took the stop loss off, and it worked great for a while. And then it just got too much to stomach, right? So it goes back to understanding that
Yeah.
you're a human, right? And you have to be able to get up and punch the buttons. And if you're an old man, then you probably have kids to feed and a house to pay for and things like that. So yeah, it's understanding what amount of pain, which is kind of what I mean when I'm talking about the smoothness of the equity curve. What kind of zone can I take in order to come back in the next day and do the same thing over and over again, even if at the end of the day I would have made a couple more bucks without a stop loss. Well, what would that have taken off my life expectancy in return?
Yeah, I mean, I think yet again, I'm going to mention path to confidence, right? You don't really have a path to confidence if you're not trading with a stop loss. Like, yeah,
Yeah.
you could do that, but are you going to be able to get to meaningful position sizes that are going to produce really meaningful profits? Are you going to be able to scale that up to a size where that really makes some serious profit for you? Probably not, right? And that's precisely because of the tail risk you would have with that. So yeah, there's a better path to confidence with stop losses, even if it's quote unquote suboptimal.
So what do you think? And we're going like way off the beaten path. I'll pull us back into the question in a second. But what do you think about account level stop losses for like days? So I'm thinking of, my days in the prop firm game and that kind of thing, where they
Yeah.
basically say if you lose X amount of money in a day, it just shuts you down entirely. I know you can do this with interactive brokers and other brokers where you can kind of call in and say, hey, if my P&L ticks under X amount of dollars per day, shut me down. My immediate reaction when I think of them is probably the same thing, probably suboptimal, but really good if you're the kind of trader who you're worried about yourself kind of going on tilt and doing something stupid. But what do you think about that when someone says, oh, if I lose $1,000 in a day, I just shut it down, I move on to tomorrow?
Yeah, I think if you're a risk manager and you're managing traders, that's an obvious thing to do, and you probably should do it. Well, the way I hear other traders talking about it, though, is a way to set that in an optimal way across their strategies to like improve their P&L or smooth out the returns. And for that, I don't like it because when you do that across, aggregating these, you're like some sort of account level stop across a bunch of strategies, you're making the assumption that all of your strategies are basically correlated in the same way or related to each other or care about what the other one's doing. And
Mm-hmm.
that's just not going to be the case. And to make that assumption, I think is a mistake. Um, it can maybe smooth out your returns a bit or like make you feel better, but I don't think fundamentally it's the right way to treat your strategies. And you should be coming up with strategies that are not correlated, right? So
Yeah.
that's sort of the whole game. So treating your account like that and doing this aggregate thing across these aggregate things that are strategies of it's like multiple layers above the actual signal, which is the signal is the important thing about the strategy and about trading.
Well, I agree with that, and it's just, yeah, it's just something. To my mind, it makes sense that it's in the prop firm space, I guess, because they're trying to manage risk across a whole bunch of traders, and it's someone else's money. But yeah, when I see people do that, personally, it just never made sense to me. Again, unless there's somebody who, will take a big hit on the day and then go back at it and do something dumb on tilt. It
Yeah.
doesn't bother me as much as the people who just stop trading when they hit a certain dollar profit on the day. That kills me. That hurts me. They're like, I want to make $1,000 a day, so when I hit $1,000, I get out. I'm like, well, what if that one day you would have made 10, right? Just based
Yeah.
off and you're just cutting based off arbitrary. I think we talked about it before. People who draw moving averages on equity curves and things like that, and they use the equity curve in order to try to
Yeah.
make a decision. It's you're assuming that there is trend to your strategy that that it you have to kind of account for. You have to assume that your strategy is going to work or not work, in some sort of linear fashion, which generally isn't going to be the way. It's going to work one day and not the other, and that kind of thing.
Yeah. So, it's just funny you mentioned this because just today I wrote a message to my newsletter about a question that somebody asked me about Monte Carlo simulations.
Hmm.
And that would be a good way. Like if you think that you're doing like trading off your equity curve and you're setting a stop or something, or like sizing based off a moving average of your equity curve or something, a good thing to do would be put it through a Monte Carlo simulator, which is going to randomize the trades in the equity
Yeah.
curve, which is what you want. And
Yeah. So I
it's
guess
gonna your whatever sort of magic strategy you come up with to do this finagling with your equity curve is probably going to fall apart when you do a Monte Carlo simulation. So,
and that's
and
just
that's I think that's the right way to think about it.
just to explain to the people again, if they don't know what a Monte Carlo simulation is, it takes the same trades that you already have in your equity curve and it randomizes the orders. And the idea is that you could, in theory, have a good-ish strategy, but if you randomize the order enough, you could go bankrupt, right? And in theory, now if the strategy is good enough, it should never happen. But the idea is that, what happens if you took 10 losers in a row, or 15, like just randomizing the number of trades so it's grouping to make sure that path dependency isn't the thing that makes your equity curve looks good. A lot of brokers, again, I know, or a lot of back tests, I know Real Test does it by default, and it just shows you what you're looking for is that even when you randomize your strategy enough, it's still profitable. It's somewhat better, a little bit worse, it's whatever. So what Dave is basically saying is that if you run it and you say, I'm going to use a 20-day moving average on my equity curve, and if it crosses below that, I'll stop trading it. Well, that's all well and good, but as soon as you randomize the trades in the order that which they were taken, that would get triggered at the weirdest times, right? It would get stopped out. And
Yeah.
the way I look at that is you're probably doing it, probably the same people do that as the same people who system hop. Instead of building new systems, they jump from one system to another, and they're probably leaving that system at the worst possible time. And it's like, I'm going to leave this system, this mean reversion system, and then all of a sudden you leave it at the very bottom of a market, which you could never predict anyway. And that would have been the system that makes all your money. It's really another proponent for multiple systems as opposed to system hopping, is because you don't know which system is going to perform well that day or week or month. But if you have enough of them together, your hope is that they're uncorrelated enough that you have one day where one system at least is making it so you're not getting completely destroyed.
Yeah. I think a lot of these ideas, count like what are we saying, like daily max loss or daily minimum gain or whatever. They're really just sort of security blankets, right? That
Yeah.
so they can. It's not that there's no value there, but look at them for what they are. They're making you kind of feel a little bit better about the risk you're taking and your strategies, but they are really just sort of security blankets.
Well, it's the same as the dreaded I'm going to move my stop to break even. Oh, that one gets me. It's like, why?
Yeah,
Well, because I'm up a bunch of money and I don't want to lose money now. Like, how scientific of you. But that
yeah,
is one of those things, like, how people say you can see the Great Wall of China from space, and you can't see the Great Wall of China. It's just something that's one dude said once, and then everyone else. It's the
yeah.
same with, oh, when I'm up a bunch, I take half and I move my stop to break even. It's the same. You're doing something, and listen, if it makes you feel good enough that you can continue on this game long enough to realize it's very suboptimal and you shouldn't be doing it, then I think that's fine. It's when I see, like, 10-year traders still doing it, you like, is that you can't think of a more optimal way to manage a position than to quickly get to a point where you don't feel any pain. It just seems, yeah,
Yeah,
security blanket's a good way to do it.
it's because they've got a target out there, and sometimes sometime in the past they've had a trade that almost hits their target and came back and stopped out, right?
Hmm.
So But if you look at
Which,
that, if you back test for that, you're going to see that you're going to need to have some of those to get the big winners, right? So
yeah.
it's you're going to have to
Well, and
stomach that.
it's funny. So what you described is the exact same thing as the person who says they came and got my stop loss and then they ripped it,
Hmm.
right? It came 2 pennies from my profit target and then it pulled back a bunch before my time stopped triggering and I closed it. But you don't hear the same conspiracy nonsense around, I had a target at 1025 and it got to
Yeah,
1015 before it reversed. And I think that's funny that it's the exact same market mechanism. And you could see a world where you could just plug in the same evil actors in there who stopped the
yeah,
price before it got to your certain level. But it never seems to work like that, especially if the trade closes in a profit anyway, because of the end of the day or the end of your time stop. It's only when it's a loss, which should tell you a lot about the psychological mechanic that makes people think this way.
yeah. Or when your target gets hit exactly to the penny, you don't
Yeah,
think, "Wow, man, I was really lucky there." You think, "Man, I'm a freaking genius," right?
yeah.
So,
It's
but you really like there's luck involved in a lot of this. So,
Well, and I would say there's probabilities involved, right? It's the you're we're testing for kind of an average and a norm, knowing that there's extremes on both sides. So just if you do 100,000 trades, there will be in that subset hundreds of trades that get within a couple pennies of a stop loss and
yeah,
then reverse just through random kind of natural luck.
guaranteed. Yeah, you're guaranteed to have that happen.
So, I guess to summarize, there is no one. They didn't install a camera in your house. They're not looking over your shoulder. They
Yeah,
don't know where your stop loss is. Now, there may be some. I generally know there may be stop losses in this area. I still don't think that they would care too much unless it was within a cent or two. But it's not your problem. I think is the biggest kind of takeaway is that if you're losing money trading, it's not because they're hunting your stop losses, right? It's again, the conspiracy theory, even if you still want to believe it, it's still not the reason, right? The reason is you're either running suboptimal strategies or you're not following those strategies. And I would say if you take losing traders, it's one combination of the two. They just don't have a strategy, period. They watch a video on TikTok and they say, I'm going to trade like this.
yeah,
Or they have a strategy and then there's something that's stopping them from actually executing and following that strategy. It's not
yeah.
the boogeyman or Ken Griffin.
Yeah, and when you have a good process for creating a strategy and selecting a stop loss, you don't have to worry about any of this crap, right? There's no like you're doing it in an optimal way, and let other pretenders worry about these conspiracy theories. Like you're doing it
Mhm.
in an optimal way, and let things play out the way that you design them to and expect them to.
So I just want a takeaway. So let's just give a couple tips on how to potentially, we talked about, using the MFE, MAE as a stop loss. Just wanted to add a couple ideas for people to kind of take away to when they're working on their strategies. For me, it's always to use normalized stop losses. That's like my one of my biggest. This is like a big pet peeve episode for me airing. I must have slept poorly last night or something. But the people who say, "Oh, I risk 10%." On the stock on a position or oh, I want a stop of 25 cents, like these don't make sense when you're thinking of stop losses. You should always normalize it somehow to how that asset moves. So again, simple ways to do it are ATR or volatility, or just look at the range of the average bar, right? If your system's triggering off 15-minute charts, say, okay, what's the average range of the last X period of 15-minute candles? I'm going to use some multiple of that for a stop loss. And like Dave said, eventually just forget about the rest, right? Find something that works across the entire back test, and then each individual trade, just don't worry about.
Yeah, I think that's well said. Yeah, the other thing I would say, the big takeaway here is when this happens to you and your stop gets hit by a penny, it's a good thing. Like you should be thinking about that as a good thing. I
Yeah,
think that's the big takeaway here.
yeah. And yeah, so I guess I can throw out my tinfoil hat then. I guess I don't need it anymore until the next
Use it
one.
for something else. Yeah, use it for something else.
Well, I do have a lot of woods in the back. Maybe I'll go hunt for Bigfoot and see if he's hanging out back there. But as always, again, we appreciate the question. This was really fun just to kind of joke back and
Yeah,
forth, but on a topic that is, it's insane how much you see this. It's something that I'd say if you polled the trading audience, 30% maybe probably believe that they're hunting your stop losses at all time easily.
yeah, yeah. If you still think that's the case, please let us know. I'd like to hear what you take. Hey, I'm open to the possibility that it's happening. Maybe I just don't have enough experience or am not in the know enough to know about this vast conspiracy. But yeah, happy to hear.
Well, and maybe we take the other side of it, right? Maybe if you know the conspiracy, how about you introduce me to the guy running the show? I'll make him my bud, and he can tell me where all the stop losses are. Right? So,
Exactly. Well,
but
thanks for Arthur for
yes,
writing this question. This is great. Good
yes,
topic.
and again, we read all the comments, right? And we kind of respond to them, and sometimes if they're great like this, they might make it in a podcast episode. So make sure you're doing your comments and letting us know and giving us feedback. But as always, I'm Michael Nauss.
And I'm Dave May. Thanks for joining us on Line Your Own Pockets.